Hello again, it's Mark Masterson, partner at Hightower, Naples, and I'm pleased you are joining me today for our quarterly market update. As always, I'm going to share our views through 3 quarters on the economy and on the capital markets and provide some color on our outlook heading into this final quarter of 2019. So thanks for being here, and let's get started. Starting with our 4 horsemen again, as you can see, it's a mixed picture and a little bit of a mess, frankly, when you look across the 4 horsemen. On our fundamental view, we're a little more negative here, at least in the short term, as we move into the fourth quarter. The fundamental picture is definitely turned down. We're going to talk about that in the next few pages. The technical picture, we're still bullish. Charts look fine. Depending on the asset class you look at, some look a little better than others. I'm going to cover that. Sentiment's now neutral. And again, it's a mixed picture there because it's a little more positive looking on the equity markets, a little more negative looking in terms of sentiment on bonds and things like gold. And then finally, from a policy picture, we're still bullish. Fed's cutting rates. All the central banks are accommodative. So, generally policy's positive, a bit of a tailwind, but a lot of questions there as well. So I'm going to cover all of this, so I'm not going to spend much time on the 4 horsemen because we're going to move through it all. Let's start with the fundamentals. And as I say here, the rest of the wall of worry. Worry, worry, worry. It's everywhere. And I'm going to show you what we're worried about and what we're not as concerned about as we move through the next quarter. One of the primary worries out there is that growth is slowing, and indeed it is. What's interesting is it's really not showing up yet in GDP. This is the most recent Atlanta Fed GDP Now forecast, and you can see the consensus has kind of stayed pretty much right at that 2% level, and that's where we are today. The Fed's been a lot noisier, but they're actually a little bit higher than the 2%. So, while growth is slowing, and that's a worry, and I'm going to show you that, the facts do justify that worry. But it's not showing up yet in U.S. GDP, at least in terms of the estimates. One worry about growth that came up earlier in the year, about a month or two ago, was the yield curve inversion. And in fact, we still are inverted on the yield curve, particularly on the 3-month Treasury to 10-year inversion. Should we be worried? Should this worry you that the yield curve is inverted? The facts say that yes, we should be concerned, with a caveat that I'm going to cover on the next page. But what you do see historically is that when we do get this inversion, which I have highlighted on the chart, and here we are today, these gray bars, which are recessions, they follow. Inversion, eventually recession, here, 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 and I suspect here as well. I mentioned on that last slide that we should be a little bit worried here about a recession given the inversion. But I said there's a caveat, and here's the caveat. The caveat is the timing of that recession. So you've seen this chart before, but for those of you who haven't, 100% batting average for the inversion. This is the two-year, 10-year yield curve inversion. Every single time we saw a recession, when it got inverted, here's the caveat, the timing. Months to recession, the average is 17 months until we actually saw that recession. So the fact is that the recession will likely come sometime within 2 years. Another fact that I think is interesting is the equity markets. If you look down here, the equity markets actually rose from the time that the yield curve inverted to when the recession hit, and the average return was about 12 to 13%. So it's a mixed bag. We've got the fact that a recession is very likely, and also the fact that the markets tend to rise into that recession, as well as a difficulty in timing when that recession will arrive. Another worry, the consumer. The consumer has been so resilient, and the U.S. consumer tends to be. This is a great chart because it shows how consumer confidence has been on the rise. Is this a peak? The reality is, in real time, you don't know. You can see in the past, though, that the consumer confidence will peak before recession. Here, and it rolled over hard. Here it peaked and rolled over hard. Here it peaked and rolled over hard. we will know sometime probably in the next 3 to 6 months whether this is the peak or do we have another spike up. The fact is the consumer has been very strong. The worry is that we are peaking. And if we are, we're going to know soon because these tend to turn down pretty quickly. And they will do so ahead of a recession. So that's something that we are watching. We'll continue to watch. Along the same vein, worry about slowing growth. We got some data just this week on the ISM, both in the manufacturing and in services. And frankly, the picture's not that great. You can see this week we saw the manufacturing hit 47. Anything below 50 is contracting. So that's not good. And then on the services side, which was reported just this morning on Friday, we had a 52 number. So it's above the 50 line, which is good, but you can see the trend is heading lower. So, neither one of these numbers are great. They both show that we are seeing slowing growth here in the U.S. They both show that the strong dollar is impacting and the trade war is likely impacting our manufacturing in particular. Bottom line here, another thing to worry about, keep our eye on, and we need this to stabilize. We're seeing these worries starting to materialize in consumer, not just in consumer, but also in CEO confidence. And just this week, we saw that the conference board CEO confidence number was pretty bad. It was the lowest reading since the fourth quarter of 2008 and the lowest since year-over-year reading since 1979. So you can see this is visibility 6 months out from a CEO perspective is not very good, and that doesn't give them great confidence. And again, in my opinion, a lot of that's due to the trade dispute, the ongoing trade dispute, and again, that slowing global growth picture. And this brings us kind of squarely into this quarterly earnings season, which frankly is probably the toughest year-over-year comps we're going to see. And that's reflected here in what's the expectation is for a negative quarter year over year. Last year, 2018 third quarter was explosive to the upside. So the comps are not good. And the challenge is going to be with global growth slowing. How's that also going to bleed into guidance? We don't know. And so that's a worry. And it's something that we're going to have to work through this quarter and see how we come out on the other side. Earnings have actually been positively surprising, but the challenge is trying to see how much of that is already being priced in and how much is being worked into estimates, because the theme has been lower your estimates and then try to beat them. And how much of that is done, we'll find out. We're going to find out in the next few weeks, frankly. Another worry is that we're later cycle. And the fact is we are. You can see this has been a long recovery. It's been a weak one. So if you go, this has been, in terms of the length, we're basically the longest that we've had. And you can also see when you compare it to other recoveries, it's been on the weaker side. So it's been a long, weak recovery. We got to recognize that it is later cycle. We have to invest accordingly, which we believe we are. And we also have to know that a recession, when you have such a long recovery, a recession is coming, and likely within 12 to 24 months. One of the bright spots has been jobs. And just this morning, again, we had a decent jobs number, better than what the street was looking for. We came in here from a 3.5 unemployment. Shows that we're, in the lowest level since 1969. So that's a positive sign. The worry would be when this turns. So you can see in the past when the unemployment numbers finally bottomed, if you will, and the unemployment rate rises, it rises fast, kind of like that consumer confidence, the other side of that consumer confidence. And that's what we've got to look for here. If we are going to start to see signs of a recession, you're going to see this start to tip higher. And when it tips higher, it'll probably tip higher quickly. So that's what we got our eye on here. But so far, that's been a bright spot. Another bright spot has been the consumer. We talked about the consumer confidence numbers, and rightly so. Look, household net worth has been on the rise at all-time high. Household debt service ratio over here has been declining, which is very good. And then the consumer balance sheet is in very good shape. And nothing wrong with this picture in terms of the U.S. consumer. So the last few slides did cover kind of some of the fundamentals, and the reason why on our four horsemen I I put the fundamentals as more negative. I hope that was clear as to why, because things are definitely looking a little more challenging in the coming weeks and months. Another risk that people have been on people's mind lately is impeachment and the risk to markets and capital markets. And this is not high on our list. Maybe if I were to, it's first of all because it's tough to handicap. There's the opportunities or the set of cases we can look at is pretty small, of course. Maybe it's a 3 on a scale of 1 to 10 in terms of a risk. Markets fell with Nixon, as you can see in the blue, and markets rose with Clinton. One thing I'll point out in the next few pages here is that both the risks and the reward picture may be from a byproduct of this, and I'll show you what I mean in the coming pages. For example, I think risks are rising a little bit coming into the next election because of the impeachment inquiry, because what we're seeing is Biden is getting caught up in it, and where Biden was the leading Democratic candidate, he's slipping, and Warren is surging in terms of the odds for Warren becoming the candidate. And what does that do for risk? So that's a byproduct of the impeachment process or inquiry. And, is there a risk? Is the market risk greater with Biden as a candidate or Warren as a candidate? And I think most would probably see the risk rising if Warren is the candidate, and even more so if Warren as a candidate becomes a front runner, or it starts to take over in terms of the polling with against Trump. On the other side is the impact of this impeachment inquiry on the possible trade war, because again, if you look at the top 3 risks right now, for us, it's the trade war, the Fed, and maybe the Fed not doing enough or too slowly, and then, of course, its impact on slowing growth. And one potential positive from the impeachment process is that President Trump is likely to maybe change his tack a little bit and follow the Clinton playbook, which was to look for wins, to legislate, during this process, and kind of make the impeachment process look more like a circus. And he's doing the people's business. And one thing that he could do where he could get a win would be on the trade war, where, this has been the process where no progress is made. They talk tough. The market sells off. The administration then starts to respond to the market sell-off. Phone call, trade talks, market rallies, and then here we go. This cycle may change. And we do have meetings next week. And there's a chance that we may get an interim deal or something to take a little bit of the pressure off from the trade war with China. Coming to that same point about President Trump needing wins as we move towards the election cycle, it's just a simple fact that it must be. If you look at the history of or the historical data around recessions and elections, it's plain and simple. If there's a recession, the incumbent loses. And if there's no recession, we get a win. So I have to believe that President Trump is very aware of these facts. And he does not want to have a recession or the economy roll over. And the trade war and some positive change on that front could certainly help his case there. And the same holds true not just for the recession picture in the economy, but for the stock market. Look, it's a near perfect record that if the stock market's doing well into the election, it's very difficult to lose the election. It does happen, but Trump is going to need the market rising. And what better way to get the market rising than to seal a victory on the trade war or some type of victory that will improve the economy, take a little pressure off, help CEOs, get trade moving, and again, help the equity markets into the election cycle. And another worry that we talked about beyond the impeachment cycle and slowing growth is the Fed. And the Fed has now started cutting rates. They've cut twice. Expectations are that they will cut again. And so the real worry here is not that the Fed will pivot. They have. That was a worry early in the year. But now the worry is that maybe they're not going to do enough. Are they going to go too slow? And here's the good news. The facts show us that when the Fed is cutting, the market tends to do well. So here's a chart showing, going back to the early 80s, the S&P 500 returns after rate cuts when the market's near new highs. So you can see the data is very conclusive. The average return is 15% over the next year. That, again, would be helpful to President Trump and his reelection hopes, but it's also helpful to us as investors. So, we do have questions and worries about what the Fed's doing and how they're going to do it, but the facts do tell us that when they are cutting, which they are, the markets tend to perform okay. And lastly, to sum up this whole section on fundamentals and worries, etc., strangely enough, policy uncertainty, especially when it spikes, tends to be good for markets. Hard to say why, outside of maybe from a sentiment standpoint, people get so nervous that the markets can deliver better results. Here you see it. So here's the global policy uncertainty index. We certainly are spiking here right now. And here's the returns going back. So you can see these red lines are the S&P 500 returns following spikes in the index. And so here's the 1 month return, the 3 month return, the 6 month and 1 year. And they tend to be better when uncertainty spikes. So keep that in mind. That's just a fact that, while you may not be able to explain it, it's certainly a little more comforting. So now we're going to move into capital markets and investments. We're going to look at some of the technicals and the sentiment that I mentioned earlier on the Four Horsemen. As I mentioned, for the most part, technicals are fine. Particularly for the equity markets. We'll look at it across different assets. But here's the bull market channel for the S&P 500. And as you can see, still in it. We kind of had a scare here at the end of last year, bounced right back in it. And what we've done really is kind of move from the top, and all this choppiness that we've been in has just moved us over towards the bottom of the channel. We'll have to keep an eye on this, make sure it doesn't break down. That could happen. Or we could break up and head up towards the top of the channel. But at least in the short term here, the bull market is intact. We still remain in this trading range, this choppy sideways market, this harder market. I kind of highlighted this in the past where we've been in this trend where we have a harder period of time for a year or two, then an easier trending market, then a harder choppy market, then an easier trending market. And we've been in this sideways, much harder environment. And we'll have to keep an eye on it to see whether we break out to an easier or stay in it or even break down. But for the most part, it looks okay at the moment. And for those of you who follow me in the Morning Roundup daily, this has been my chart. I've been showing you that the S&P has, formed this rising wedge. And I showed that in the past, these things tend to break lower. It did it here. It did it here. And again, it did it. But I also highlighted just yesterday that we had some support that we were coming up to, this blue line. And the market was finally getting oversold. This morning and yesterday we had a great looking reversal, and now we're getting some follow through. So in the short term, the technicals here for the market look pretty good. I'd actually say this looks ripe for a bounce for a couple of weeks, maybe even through into the Fed meeting at the end of the month. I've also pointed out in the roundup that the fourth quarter does tend to be seasonally positive for the markets. You can see that here, whether it's been a bad year for stocks or a great year for stocks, the fourth quarter tends to be pretty good. Last year was an anomaly there, but it's something maybe from a factual standpoint and historical context looks pretty good as we move into the fourth quarter. And we've also been kind of staying right on the historical pattern. When you look at the third year of a presidential cycle, that is playing out true. You can see that here. And also, you can see the quarterly. First quarter and second quarter were really strong, as they typically are during the third year of a presidential cycle. Third quarter, not so much, and then the fourth quarter tends to be up. So far, so good. And you can see it here in this chart showing the S&P 500 typical, going all the way back to 1950. We tend to be strong out of the gate in the third year of an election cycle, which we were this year. And then we move sideways throughout the summer. A lot of chop, and that's what we've been doing. I have a circle here showing kind of where we are now in that September to October period, and you can see we tend to see weakness, which we've been seeing. So, we may see some more as we move through October and then finish strong into the end of the year if the pattern holds. One bright spot, at least in the short term for the equity markets, is sentiment. I mean, I highlighted just a few weeks ago that the smart money, dumb money had me a little worried because this red line here, which is the dumb money index from Sentiment Trader, had peaked up into extreme optimism. But you can see that fell off a cliff as the smart money's getting more optimistic. And just this morning, I saw the AAII survey shows that bullish sentiment has plunged down to 20% with bearish up to 40. As a contrarian indicator, I'm going to tell you that makes me smile. And again, that kind of lends a little more credence to me that at least the next few weeks, that the market may have a nice little bounce here into the end of October, into that Fed meeting perhaps. And maybe the trigger will be some positive news next week out of China. But sentiment right now is kind of neutral, but it definitely has improved since 2 weeks ago. We're seeing the same thing in the put call. The put call ratio spiked up into like the 96th percentile. That's usually a sign of fear. When people are buying a lot of puts, they're expecting the market to plunge. They're buying protection, and spikes like this tend to mark bottoms more often than they do tops. That's for sure. And broadly speaking, from sentiment, investors have been scared. This is from August, but cash was the largest allocation at the end of August, and we saw huge outflows in stocks. So, certainly the equity market, people are voting with their wallet, and they're not confident. And that, as a contrarian indicator, suggests that there may be more upside. And that's been the case throughout this entire bull market run. This old favorite of mine from J.P. Morgan, year to date. Now this data is a little old, doesn't include September, but year to date we have negative flows into U.S. equities, and that's been the case. All these highlights going all the way back to the beginning of this bull market. We've only had, this is just pathetic. Investors just have not been buying U.S. stocks. Instead, they've been loading up on bonds. Look at this again, $251 billion added to taxable bonds this year. So granted, bonds have done fine. I certainly understand why that'd be the case with, the bond market's up 6 to 7%, but the equity markets are up 18, and yet we have negative flows. And that's been the case. So all I can say is this type of love or lack thereof for an asset class is not something that you would check the box at the top. This looks more toppy than this. And speaking of bonds, our view hasn't changed. You can see we think that we're in the bottoming process. This is a great chart for market anthropology, and it shows, a history of yields. And you can see interest rates, they rose way back here from 1940, and we peaked in interest rates in 1980. So this was a bear market for bonds as interest rates rose, and we've been in this huge bull market for bonds as interest rates have fell. And we think we're just going to kind of bottom and then eventually start moving higher. People have been trying to pick this bottom for years, and they've been wrong. So we're certainly no smarter than the Bond King and others who have tried to pick this bottom. We don't know when the bottom's going to be here. And frankly, if we were to just look at this chart and you try to pick it based on symmetry, then we have another year or two of chopping around before we find a bottom. So bonds may certainly keep rising. One thing I will note, and I'll point out again in this chart, and this is from my roundup, is when I looked at the weekly, this is the TLT, which is just an ETF that is tracks the 20-year Treasury bond ETF. The weeklies got so overbought just a few weeks ago, and I just highlighted it as a concern because the last few times that we saw the weeklies overbought like this, we ended up with a pretty big bond market correction. We started to slip a little bit. We're rallying back. I would say give bonds time. I think you have to work this off a little bit. People just got so enamored and maybe a little too much in love, and maybe we need to kind of chop and correct and work that off a little bit more. Just my view. And heading into the last bit of the presentation, we are in a currency war. This is a great cartoon from Hedgeye showing everybody blowing each other up. That's what we're seeing from central banks. And the bottom line is the Fed's losing at the moment. And by that, I can say only that the dollar continues to rise. The dollar is surging here, while every other currency is going down. And it's just because, there's a number of reasons for that, but one of them is that the Fed is less aggressive in their easing than, say, the ECB or the Bank of Japan. And, whether you're happy with this or not, the bottom line is that the dollar is hurting manufacturing being so strong. And so this chart shows the dollar. We're kind of hitting that moment of truth. We're either going to break out above here or it's going to break down. And I think it's important that perhaps we get more of a breakdown, but we'll see. And you can see, here's the euro and there's the dollar. The euro has been collapsing as the ECB does more QE and really pushes hard, and the dollar is rising. And maybe this needs to reverse for us to see where the Fed comes in a little more aggressively, drops the dollar, and the euro rises. That tends to be the case where we see these things tend to roll together. I'm keeping an eye on that. The impact of this currency war that we're seeing has been seen in various places. One has been in the price of gold. Gold's having a solid year this year. You know, that's one of our core holdings. It varies in terms of whether we're overweight or underweight, but this year's been great. I've pointed out in the past that the returns of gold have been fantastic in U.S. dollars going all the way back to 2004, with the exception of this bear market. Last year was pretty modest, although better than the markets, equity markets. This period is what most people remember, but so far this year it's been a solid year for gold. And one of the reasons that we are positive is because from our lens, it looks like gold has been putting in a very big 5-year rounded bottom. This year we're seeing a nice breakout from that 1390, 1400 level that it just couldn't quite get above for multiple years. Finally broke out above it. So that's all good news. The only thing I do point out is that I do still think gold may have to rest a little bit, kind of like bonds. I showed that weekly chart of TLT for the 20-year Treasury. Well, gold is still overbought on the weekly. And in the past, when we've gotten to the level where gold has been overbought up here, it's usually been before a downturn. Here you got overbought, had a big downturn. But even during the rise, the bull market, when it got overbought, we do tend to see a pullback, a correction. And we are seeing one, but gold's holding the line really well. I wouldn't be surprised to see gold have to take a little break, kind of work this down a little bit. Maybe we see gold correct over the next few weeks and months, kind of chop around back down towards the top side of this. We'd love to see this pull back all the way, maybe even all the way back to 1400, test the breakout from the other side, then it could really take off. So that's kind of what we're looking for, in terms of the gold holding. Thought I'd get you up to date there as well. So I'll end it there. And as always, thank you for taking some time out of your day. I know time is valuable, and I appreciate you listening to, our thoughts and commentary, where we've been and where we're going. And you can reach me any way you like. You can call, you can email, you can text. You can always follow along at the morning roundup, sign up at our website, call me, email me, whatever works for you, and stay on top of what we're seeing for our clients and the families that we serve. So have a great day, and thanks again for joining me.